Welcome to Fairport Flash, the monthly economic update powered by the Fairport investment team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Welcome to Fairport Flash. My name is Rick D'Amico, Manager of Investments at Fairport Wealth. As part of the investment team, I'm mostly responsible for managing the firm's fixed income and liquid alternative investment strategies. Today, I'd like to touch on three topics. First, the recent gyrations we've seen in the Treasury market. Second, the implications of the large amount of negative yielding debt we are seeing across the world. And third, our expectations for Federal Reserve policy as we close out 2019. So let's get started. Since I last spoke in the June Fairport Flash, U.S. 10-year Treasury yields have continued to plummet, falling as low as 1.43% on September 3rd. Yields challenged long-term support levels last seen during the 2012 euro crisis and in 2016 when there were fears of a hard landing in China. At one point, 10-year yields were down over 125 basis points from where we started the year, and 30-year yields fell to 1.9%, their lowest level in history. The sharp drop in rates has been a boon to longer duration fixed income securities, as long U.S. Treasury and long corporate bonds have returned 18.97% and 20.82% year-to-date, respectively. Evercore ISI cites 10 fundamental reasons why U.S. bond yields are so low, most notably the U.S.-China trade war. However, other reasons include slower global and domestic growth, low inflation worldwide, Brexit, and negative foreign yields. Let's focus on that last reason for a moment, which has been a hot topic, and that's negative foreign yields. As of the end of August, the amount of negative yielding debt rose to an astounding $17 trillion. To put this in perspective, on a global basis, 30% of all investment-grade bonds are trading at negative yield levels, guaranteeing investors a loss if they were to buy these securities and hold them to maturity. As recent as last week, the entire German bond curve was negative, with the 30-year German bond yielding negative 0.012%. It seems like crazy town. Why would anyone purchase a bond with a negative yield, essentially guaranteeing themselves a loss? One reason is that investors are betting that rates become even more negative, pushing the value of their bonds even higher. This scenario could unfold in an environment of easy monetary policy by global central bankers, especially if they resume their asset purchase program. Another reason is that you still have large financial institutions and pension funds who must have the liquidity and stability of government bonds, and there are not many other options that offer this type of size and liquidity. It remains to be seen what the longer-term ramifications of negative interest rates will be, but as Ned Davis research points out, there are some potential dangers. The first danger they identify is financial repression, where you have an environment in which negative real yields penalize the savers, who must now save more in order to meet wealth targets. On the other hand, negative yields reward the most highly leveraged governments, businesses, and households as they stand to benefit the most from the reduction in interest costs. Second, there's the possibility that negative rates entice investors to take on too much risk as they stretch for yield. This can potentially lead to overvalued assets, such as in high-yield bonds, and financial instabilities as investors continue to pile into these asset classes. Negative interest rates also leave no room for effective monetary policy during the next downturn. In our view, it is very important to keep an eye on global yield levels because the amount of negative yielding debt overseas has a direct impact on U.S. 10-year yields through the U.S. term premium. As you recall, this is the excess yield investors demand in order to hold long-term bonds. The amount of global negative yielding debt and the U.S. 10-year term premium has been highly correlated since 2017. The 10-year U.S. term premium hit a record low of minus 115 basis points last week and helps explain why U.S. 10-year yields have traded at such low levels. Now on to the Federal Reserve. It seems like a foregone conclusion that the Fed will cut interest rates by at least 25 basis points at this month's FOMC meeting on September 18th. A couple of weeks ago, St. Louis Federal Reserve President James Bullard made the argument for a 50 basis point cut. However, market odds of a 50 basis point cut have fallen considerably since then and are now down to just 3%. It appears more likely that the Fed will cut rates 25 basis points in September and another 25 basis points in October, rather than going 50 basis points all at once. In any event, the benign inflation environment gives the Fed plenty of cover to cut rates. Core inflation continues to slow around the world, and it appears as though the U.S. core PCE will not reach the Fed's 2% target anytime soon. If the Fed does indeed cut rate by 50 basis points over the next couple of meetings, it would put the U.S. more in line with policy rates around the globe and could perhaps help stem the run we've seen on U.S. Treasuries over the past couple of months. So in closing, how have these recent developments impacted the way we manage fixed income portfolios? And are there any opportunities we are seeing in the fixed income market? We've already talked about how low domestic and global bond yields are on an absolute basis, so we maintain our short duration position relative to the Barclays Ag benchmark. The danger in these low yield levels is that it does not take much of a backup in rates to essentially wipe out an entire year's worth of coupon payments. For example, since the low in yields on September 3rd, 10-year yields bounced 30 basis points to current levels at 1.73%. The quick bump in rates is attributable to the first increase in the global PMI index we've seen since 2017 and increased trade optimism surrounding the October talks between the U.S. and China. Over that 2-week period, the value of the 10-year fell 2.45%. So as you can see, it does not take much of a move at these low yield levels to have a significant impact on returns. From a valuation standpoint, most sectors within fixed income still appear rich relative to historical spread levels. Investment grade and high yield corporate spreads remain tight and are well below their historical averages. Agency mortgage-backed securities are beginning to look more attractive. Spreads have widened and are now close to their historical mean, while the duration of these securities has shortened due to an increase in prepayments as homeowners refinance with the drop in mortgage rates. Treasury inflation-protected securities, or TIPS, also appear attractive when compared to nominal treasuries. So those are two areas we're keeping an eye on, but overall we remain cautious on fixed income going forward, given the current level in rates and the tightness in credit spreads. While we do not currently see a catalyst for a sharp backup in rates, it appears as though we are stuck in a lower for longer environment, which would generate modest returns at current valuations. This brings us to the close of today's Fairport Flash. As a reminder, our goal at Fairport is inspiring families, and as a member of the investment team, we strive to do this through a long-term and diversified approach. If you would like to discuss any of today's general topics in more detail, please reach out to your Fairport team. Thank you for listening, and look for the next Fairport Flash in about a month.
Fairport is a group of investment professionals registered with Hightower Securities, LLC, a member of FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinion, news, research, analysis, prices, or other information contained in the research is provided as a general market commentary. It does not constitute as investment advice. Fairport and Hightower shall not be in any way liable for claims and make no express or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements and errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Fairport and do not represent those of Hightower Advisors, LLC, or any of its affiliates.